Jacob, tell us something that you believe about investing in self-storage that might surprise us.
One consistent misconception about self storage is that it's easy. No tenants, no toilets, no problems. We hear about that a lot, and that could not be further from the truth. I guarantee you, somewhere right now in one of our units around the country, there's some bad stuff happening. Someone's cooking meth, or they're breaking in, or they're sleeping in the unit, or they're storing illegal substances of some kind. So it's a challenge from a management perspective for sure.
Listeners, welcome to the Source of Commercial Real Estate, where we talk to the experts in non-residential commercial real estate so you can grow your business, find a competitive advantage, and use real estate to live the life that you want. I am your host, Jonathan Hayek. I'm a former public school teacher who found financial freedom through residential real estate investing, and now I invest in commercial properties, particularly small industrial. Today's guest is Jacob Vanderslice. He's a co-founder and principal at VanWest Partners, a Denver-based real estate investment company specializing in self-storage facilities. They acquire, develop, and manage self-storage. VanWest has established a track record with over $250 million in assets. Welcome to the show, Jacob. I am sincerely excited for this conversation.
Great to be here today. Thanks again for having us on.
Jacob, why don't we start the conversation with you telling us a little bit more about your background, how you got started in real estate, and what your work looks like today?
Yeah, we got started investing in real estate full time back in 2006, and we started off like a lot of people, kind of transitioning into the space by doing a small amount of residential properties. Our first duplex was here in Denver. Fixed it up on our days off, found the tenant ourselves, no background check. I think some guy just walked up to us and we signed a lease in our early 20s. You don't know what you don't know when you get in, right? And we scaled that business over time, and over many years, we ended up doing 11 or 1,200 fix and flips all over the country, mainly in Denver, but we were operating in Vegas, Phoenix, Central Valley, California. We got into commercial real estate in 2013 and 2014, and we started off doing adaptive reuse retail projects. So basically converting old buildings around town into breweries, restaurants, yoga studios. Did some town developments, some multifamily. So we covered a lot of the real estate food groups over the years, and we had been looking at self-storage for a while, and we liked the notion that the asset class is historically recession resistant, it's scalable, it's durable. One of the reasons as we look in the rearview mirror, that we didn't like our business at the time is it was kind of overly transactional. We were buying and selling too often and too quickly. And we thought storage was a good vehicle to kind of shift that thesis to more of building an asset base. It's responsibly financed. It creates cash flow. So we did our first storage deal in 2015, and we kind of jumped in head first. It was a multi-story development project here in Denver. And we did a few others, and over time we evolved into primarily being a self-storage owner-operator. So we bought a deal last week. We sold a couple deals 2 weeks before that, but currently we've got 38 properties around the country.
Will you talk more about VanWest Partners? You've been using the pronoun we a little bit, so I'd love to hear who we is and describe a little bit more about what your current business strategy is.
Yeah, we have an amazing team, and I have very little, if anything, to do with some of the successes we've realized over the years. We have just about 90 employees, and about 20 of those are in our Denver office, and the other 70 are various regional and on-site managers at our facilities around the country. And our core business strategy is essentially targeting self-storage facilities that are undermanaged. They've got below market rents. They've got above market expense loads. Maybe the owner operator, built the facility 20 years ago. They have a low basis. It was just kind of a side hustle for them. So we find value in these opportunities with our ability first to rebrand the facility, but mainly from more effectively operating the facility. So increasing physical occupancy, increasing existing customer rents, implementing ancillary revenue streams. So yeah, we're just targeting these undermanaged facilities in a variety of target markets and adding value through more effective operations.
Can you give us a 30,000-foot view of the self-storage asset class as it stands today? Lots of different areas of commercial real estate are having a hard time over the last 2 years. Will you kind of bring us up to date on where self-storage finds itself in that mix?
Yeah, self storage is, of course, unique. And one of the main reasons it's unique relative to other real estate asset classes or commercial real estate asset classes is the fact that leases are month to month. So you've got customers who stay in their unit much longer than they anticipate, but all the leases are month to month. So the customer likes that because they can be flexible on when they come and go. It's no long term commitment. And that works on the ownership side too, because we can optimize our revenue on a monthly basis based on demand for that unit type within the submarket. As it relates to overall consumer demand, so the industry saw a historic increase in consumer demand following the COVID years. People were clearing out their third bedrooms for the home office, working from home. A lot of new job flexibility was created, so people moved to more rural markets that were more affordable. Really, mobility is what increases consumer demand. And so all of us, REIT operators, smaller operators, medium-sized folks like us, we saw historic revenue and NOI growth coming out of the COVID years. And really the theme for 2023 on the consumer demand front was that growth was moderating back down. It was still higher than pre-COVID levels. And I loathe talking about COVID here as much as you do, but we gotta reference it, just given how much it affected self-storage. But 2023 consumer demand was much lighter than it was, of course, with the boom years in late 2021 and part of 2022. And we're seeing consumer demand really come back in the early stages, or I guess we're almost halfway through 2024. As it relates to transaction volume, it's a consistent tale in real estate right now. Whether you're in residential, commercial, multifamily, whatever the case might be, transaction volume's way down because sellers that don't have to sell don't want to take a lower price for their asset today. Buyers that are out there are looking at their models saying, dude, I got to finance this thing at a 7% interest rate. How can I pay you a 5 cap, right? And make my numbers work. So transaction volume is definitely muted. So there's very little deal flow out there, very few deals going to market, and there's a lot of capital competing for those. A lot of new institutional players in the space that weren't here a year ago, a lot of new private equity. So the classic supply and demand curve, you've got more cash and more buyers than there is inventory available to buy, not unlike the single family market to a degree. So despite interest rates and despite a lot of the headlines about commercial real estate, self-storage values remain fairly buoyant and cap rates, believe it or not, remain fairly compressed.
You mentioned that there seems to be more buyers, both REITs and institutional players, and just it seems like more competition in the self-storage space. Why do you think that is in the last year?
I think it's it's to a degree, it's a flight to safety and downside protection. As I mentioned earlier, historically, self-storage is pretty resilient when there's an economic softening. And really, American mobility is the fundamental demand driver of self-storage consumer demand. So if the wheels come off the bus with the economy, people might be downsizing from a larger home to an apartment. They need somewhere to keep their stuff. They don't want to get rid of it, so they need storage. So I really think that it's kind of a flight to safety to a degree. And up until, I don't know, the last 3 years or so, it was much more of an overlooked asset class than it's been the last couple of years. So it's grabbed the attention of larger players who weren't in the space before. Blackstone, who we've all heard of, bought a massive portfolio a couple of years ago from Simply, ended up selling that fairly recently. So there's new players in the space that weren't there before, and I think they just like that diversification and, right or wrong, that downside protection that it offers.
So I guess use your crystal ball a little bit. Where is self-storage headed? I think a lot of different commercial asset classes experienced turmoil in lots of different ways through the COVID years, and we seem to many of these asset classes are now sort of reverting to the mean. We're starting to compare performance to 2019 levels, pre-COVID levels. So, what do you think? I mean, throwing out the COVID years, because a lot of us, certainly in industrial, multifamily, it's almost like we can't take those years seriously because they were just pulled out of nothing, and yeah, we just can't really take those numbers seriously. And so, I guess looking forward, what is your prognosis on the future of self storage?
Well, the most recently, so the REITs reported their information for Q1, their same store sales comparing Q1 of 23 to 24. And keep in mind, they're coming off of a historic increase in consumer demand, but in aggregate, they're showing a year over year reduction in net operating income, about 1.4%. So a pretty nominal loss quarter over quarter. Um, as far as looking into the future, I mean, we could get way macro and talk about 30 years from now, which maybe I will for just a moment. Um, but it's really a tale of the submarket. It's not so much where the industry is going. It's kind of where's your deal and what's happening in that submarket. And one of the major risks in self storage is new supply. And self storage is very local supply sensitive. So if you have a market that's getting supply shocked, you might have a submarket in the same MSA it's doing really well, but a submarket on the say southwest part of that MSA, a bunch of folks are coming out of the ground at the same time, and you see consumer demand staying stagnant and occupancies and rates go down. So that's one thing we look at really carefully. As far as the long-term trends go, and kind of reading the tea leaves into the future here, we're of course seeing a big shift to technology. There's a lot of operators out there that are doing completely remote managed facilities where there's no on-site manager. We experimented with that some years ago and we failed. And we've learned a lot by failing. We've learned very little by our success, but the failures, they stick in your head like they were yesterday. So that's a big trend. And generally consumers want a seamless leasing experience. So they want the option to talk to a person or see a person if they want, but if they don't want that, they want to be able to make their reservation online, make their payment online, sign their lease online, get their gate code. So technology integration is a lot more meaningful in the industry than it was, just like a lot of industries, say 5 years ago. Way down the road, one of my partners is a big tech guy, and he's right or wrong concerned about the impact of self-driving cars. Right? If you're getting in a self-driving car every day, and you've got a garage in your house and you don't have a car anymore, suddenly you've got a lot of extra room to keep your stuff, and you may not need storage anymore. Millennial demand is also not a concern necessarily, but something we're looking at very carefully. Demographic trends for millennials suggest they're not accumulating stuff like the prior generations did. Will they kind of return to the ways of their parents in some years? They might. We have some markets with a lot of millennial customers, but will millennials store like prior generations have in the coming years? And that remains to be seen. So our outlook is overall positive for the industry. There's been a lot of pain in a lot of asset classes as we referenced, and I think a lot of that pain certainly had to do with rent and maybe overzealous underwriting assumptions, but much of it was due to the rising interest rate environment that we're in. If you got a floating rate loan, say in 2022, whether it's a storage facility, multifamily, industrial, you didn't buy a rate cap, you probably have a problem today, right? Your interest carries maybe almost tripled. Your lender might be barking at you for loan covenant violations. So that's where a lot of the distress is coming from in the market, not just in storage, but in all asset classes.
I want to ask you about that potential upcoming distress. A lot has been made about potential distress in multifamily, and that has largely not transpired the way a lot of people thought it would. A lot of that distress was based on floating rate debt. I imagine in the self storage space, as in a lot of my loans, they're not floating. My loans aren't floating. I imagine yours aren't floating. Maybe they are. You can correct me, but they're fixed, but only for a certain amount of time, 3, 5, 7 years. And then it could either balloon or adjust at that point. Correct me if I'm wrong about those lending assumptions. And do you anticipate some distress eventually from those people that have, term loans, and eventually they're either going to balloon or adjust?
Yeah, well, no matter what kind of debt you're in, you're going to have a maturity date someday, right? Even if it's long-term fixed, your debt is not going to go on in perpetuity. It's going to mature. Um, we're always wrong about these forward-looking statements. We thought we were going to see a wall of maturity distress a year ago. We thought it was going to be kind of Q2 going into Q3 of last year, and it never materialized. And then we said, oh, maybe it's going to be Q4. End of the year, it's going to be a bloodbath. And there's problems out there, but I wouldn't characterize the distress in the market as macro necessarily, despite the headlines we see. I mean, office is one that's certainly macro, right? Office properties have gone through a major value reduction. But there's distress out there on a micro basis. You've got an operator with a loan maturity issue here or a loan covenant issue over there. But we're not seeing assets on a macro level devalue by, say, 20%. And we're still seeing deals trade for pretty compressed cap rates relative to where interest rates are today. So it just kind of depends on the asset class in the market. To answer your question earlier, we do have some floating rate debt in our portfolio. We also have a lot of long-term fixed rate 10-year debt. The majority of the floating rate loans that we originated, whether this was a good decision or not, we'll see in the coming quarters and years. But the majority of the bridge that we originated was done in 2023 and even this year. And the reason we were doing that is we didn't believe interest rates had a lot of room to go up further. And the terms we were getting on term debt, meaning long-term fixed rate debt, had overly punitive prepayment penalties, meaning you might lock up your rate for a fixed rate for 6 or 7 years, 5 in some cases. But if you pay the loan off early, let's say interest rates drop, and we certainly expect them to, although not anytime soon, we're going to hurry up and wait there. Let's say interest rates drop in 2 years into the hold period, and you want to refinance from maybe a 7 to a 5.5. A lot of these loans we were seeing had prepayment penalties that were 4 or 5% of the loan amount in the first couple of years. So we kind of did the math, and all right, we're slightly higher on our bridge debt, but it's totally refinanceable. We want to be positioned to be able to refinance when and if interest rates drop and not have big handcuffs tied to us with a massive prepayment penalty. So there's a lot of operators out there, though, that originated bridge debt and most of their portfolio back when rates were very low. And they're definitely going through some distress right now. But we're not seeing it as much because lenders are doing workouts. They're pretending and extending, so to speak. They're modifying loans. Operators are doing capital calls to shore up their capital stack. There's a lot of new pref equity and mezzanine financing offerings out there that are brought to bear to really help some of these operators get through this high interest rate environment before they can refinance. So that's a dangerous thing for sure. It makes a good deal better, but it certainly doesn't make a bad deal good.
With the market the way it is, interest rates the way they are, I imagine your business strategy is largely based on a 5-year hold strategy. Has the current market thrown your strategy off in any ways and complicated your business strategy?
Yeah, the interest rate environment certainly isn't helping. Returns today on a new deal that we might buy are probably going to be lower than they were on a deal we bought 2 years ago. And a big reason for that is we're generally coming in with lower leverage, typically around 50% of total cost versus maybe 2 years ago, we were coming in at 60 or 65. So that lower leverage is inherently more conservative, but because you're using more equity in your capital stack, the returns on that equity are going to be lower because it's less bank debt and more equity. So it certainly had an impact on us. Our hold strategy hasn't changed much. Within all of our offerings, we have a expected hold period, but nowhere in our documents does it state we have to sell within a certain number of years. It's more just kind of we're gonna monetize this when the market's appropriate to monetize it. So we have, for example, our Fund 1 portfolio. We've either refinanced or distributed most of the equity back to our investors and ourselves included. And we have 8 years of debt maturity left on that portfolio. So our intention to sell is out the window indefinitely. We're enjoying the cash flow. We've got long-term IO debt locked up for a long time, and interest rates are not certainly lower than they were in our interest rate in Fund 1. And then likewise in Fund 2, we had a guided hold period of about 7 years. And we closed that fund, call it January of 22. And we've already sold 3 deals off just because they made sense to sell. So when it makes sense, we'll sell quicker if the multiple and the overall return are attractive and we kind of balance that liquidity event against future cash flows. But generally, we're still underwriting to that 5-7 year hold period, depending on the vehicle. And we're either going to probably sell it sooner or we're going to sell it later. It's pretty rare we sell a deal right on time with what the model says.
I want to go back to the comments you made in response to my opening question. And so something that you shared that might surprise people is that self-storage is not a low management asset class. And I think it's interesting that you brought that up because you came from the residential world in doing 11 to 1200 flips. You were knee deep in residential stuff, and that is high management. And so part of me wonders if you saw this self-storage asset class and thought, oh, okay, no toilets, tenants aren't living in my space. This might be a lot easier to manage. And then now 38 properties later, you know that somebody somewhere in your properties is doing something that they shouldn't be doing. They're storing stuff they shouldn't be storing. So I wonder if that management aspect to self-storage was surprising to you and how you think about management. What is your philosophy of managing self-storage?
That the management complications was very surprising. And, the grass is always greener, right? You look at our new strategy, it's going to be easier, it's going to be better. In a lot of ways, it is better. But it comes with its headaches, just like residential might or industrial, anything. And one thing that we were surprised about is the amount of theft issues that you might experience. It kind of varies from deal to deal, but our first property was just east of downtown Denver. And after it was built, as we all know, we won't get into the politics of this during this conversation, but Denver's and a lot of markets in the country have experienced a huge surge in the homeless population. And we didn't appreciate what a challenge navigating customers that are homeless would be. And you can't blame them, right? It's 20 degrees out and they try to sleep in their unit, which they're not supposed to. But if you've got an interior climate controlled building and a guy pulls down the door right before it closes and your on-site manager doesn't see him, you got a guy sitting inside your building overnight for whatever, 12 hours until it opens up again. And major issues are created there. We also didn't appreciate getting into it, how much of a retail consumer-facing business self-storage is. We are, to a degree, we're kind of a retail business before we're a real estate investment company. We've got 18,000 plus units, thousands of customers. And if you think about it, let's say you're getting your coffee in the morning on the way to the office and you do your mobile order at Starbucks, you show up, you get your coffee. You want to be at Starbucks. You want to walk in there, the music's playing, it smells good, you get your latte or whatever you drink, and you're happy. In storage, regardless of how good your circumstances are, you don't want to be going to your storage unit, right? And a lot of our customers are there for really bad circumstances. Maybe somebody passed away or they lost their job or they got divorced. So having that customer service component at the forefront is really important. And we certainly didn't appreciate that when we got into the business. And really our management philosophy is, I should say, when we first got in the business, we outsourced our management to the national REITs. We thought, okay, they're bigger than we are. They know what they're doing. They can do it better than we can. And, big surprise, we found over time that third parties don't care about your deal as much as you do, right? Their expense loads are fairly bloated. They're not paying attention to the store. There's a lot of ancillary income streams in storage, like tenant insurance. that some of the larger REITs will keep for themselves and not share with third-party owners. So as we looked at our income statements over the quarters and over the years, we concluded that, hey, maybe we can't do this better, but maybe we can put up better numbers because we care more. We're real estate entrepreneurs. We know how to operate real estate. So we slowly started taking our deals back from the REITs and self-managing. And we've self-managed our entire portfolio for a number of years now. And really effective management is at the core of creating value in real estate. And the fundamental thesis in value creation in real estate is growing net operating income. And for those of us who are listening who are not sure what that is, NOI is purely your gross income minus your expenses, not including debt service. And most real estate assets are valued on a multiple of that NOI. So little increases or decreases in NOI are a material change in the overall value of the project. So we found that controlling that management platform and only managing what we own, nothing for third parties, allows us to more effectively control our NOI and grow NOI over time. And management's a tough business. It's a low margin business, but people often say you got to buy it right, and I agree with that to a degree. What does that even mean, buying it right? But I would suggest that even more importantly is you got to operate it right. You might make an acquisition mistake and maybe buy a deal and pay too much for it, but if you have operational excellence, you can still create value, and that's why we self-manage.
You talked about in the early stages handing over management to third parties, thinking that third parties know what they're doing, they're going to do a better job than you. What do you think some early mistakes are that a lot of self-storage investors make, whether it's factors they underestimate, like the homeless population in the area, or if it's rents that can be achieved? What do you think are some low-hanging fruit for management characteristics that can be improved in a self-storage property?
Yeah, well, I'll talk about management, but as it relates to underwriting, one thing that's often missed, and we've missed this on deals too, especially early in our storage careers starting in 2015, but not quantifying, understanding, or appreciating the risk of new supply. New supply analysis is very important. And obviously, no matter how much you do, you can't stop a public storage 3 years from now from building a 100,000 foot facility a half mile away from you. There's a lot you can do to understand the risk of that, though, and kind of mitigate that as much as you can. I think another common mistake that's made when someone's maybe buying their first storage facility is doing a small deal that's maybe only 20,000 square feet. Maybe it's all in at $1 million or $1.5 million, and not appreciating that in self-storage, there are fixed operating costs. If you're going to man your facility, you got to hire an on-site manager, and an on-site manager is going to cost you the same, whether it's a $10 million deal or a $2 million deal. So if you're doing a small deal, you've got these fixed operating costs that really erode your overall value creation and NOI. So that's one thing that I think a lot of people kind of miss. So I'm going to go do this tiny deal. I'm going to, on a pro rata basis, I'm going to lower my expense load based on the net rentable square footage. And if you're staffing it, you still have to hire that person. They still cost the same amount. So I think kind of underappreciating the impact and risk of new supply and not correctly quantifying fixed operating costs are two mistakes that we've made and that we see other people make fairly often.
Why does it not work to manage remotely? Why do you have to have somebody working on site?
Well, I'll say it didn't work for us. And that's a big shift in trends. Extra Space, for example, bought a big unmanned portfolio in the Southeast last year. There's a couple other shops out there that almost exclusively run their portfolios and their assets unmanned. We were just never able to figure it out. And one of the reasons it didn't work for us was when there's a customer problem of some kind, and there are plenty, as we've talked about, not having a person there to solve that really erodes the overall customer experience. Now, we have a handful of sites that are run as satellite locations. They might be a quarter mile away from a larger facility that we own, and those aren't staffed full time. But if you lease a unit, you come to kind of the main location, you drive over and load and unload at the satellite location. But I think just that lack of ability to consistently quality control the facility, cleanliness perspective, unit audits, unit walks, just not having eyes on it really created some customer service friction. And other folks, I think, are figuring this out better than we did, but we concluded that person being there was important to our customer experience.
Jacob, I want to ask you about kind of a pattern that I see as you've grown multiple businesses. I think I read in my notes that you have a background as a firefighter. So not in a business related field, but
Yep.
somehow you got involved in flipping houses and you flipped over 1,000 houses. And I've flipped houses. I've probably flipped 30 houses, and so I'm always interested in people that have figured out a way to scale and scale big. You didn't just flip 100 houses or 200 houses, but over 1,000 houses. That is, and if I'm remembering what you said correctly, in multiple markets, not just local to you. And then likewise with VanWest, you've scaled to 38 properties, 18,000 units. You have 90 employees. Your background as a firefighter does not strike me as something that would lead you towards this propensity to scale your businesses. And so I'm just interested in kind of your philosophy or your mindset in when you're building a business. You're not doing it just for yourself, and you're not doing this as a side hustle or something you're growing for yourself for retirement. You're growing it to scale it. So can you talk a little bit about your philosophy in growing your businesses?
Well, we always talk about scale, right? Every entrepreneur wants to get bigger, and what some of us kind of fail to think about is bigger is not always better, right? More scale is more problems, more overhead, more risk. But our philosophy on wealth is really durable, recurring revenue streams, not transactional revenue, not buying and selling to make money, but building an asset base that's responsibly financed, conservatively financed, that creates durable, recurring revenue streams that grow over time, and eventually you monetize that. In our business, returning to scale, again, bigger is not always better. But in storage, as you kind of build your flywheel of employees, your operational platform, the larger you are, the more seamless it is to add new properties to your asset base. You've got a playbook on transitions, on rebranding. Our operations team was just out in Jacksonville, Florida last week in one of our new acquisitions. And the transition was one of the more seamless transitions, taking over from the prior ownership to our team, because we've done it so many times and we've learned from our mistakes. So with scale comes processes and systems. With scale comes an increased ability, as we touched on a moment ago, to be able to amortize those fixed costs across a larger asset base. And not unlike other real estate asset classes, often with scale comes value. And so, for example, if we sold our entire portfolio, notwithstanding whatever the market's doing and interest rates and values, if we sold our entire portfolio off today, likely the whole would be greater than the sum of the parts. Meaning, let's say we sold one of our deals in Florida to some regional operator that's kind of small. They have a couple stores. Well, they might pay us the equivalent of, say, a 6 or a 6.5 cap. But if we sold the entire portfolio at once, including that deal, a large buyer might pay us a 5 cap. So with scale comes kind of value creation and aggregate and cap rate compression, in addition to just being able to more efficiently buy and sell properties with your operations team. But be careful with scale, right? A buddy of mine's got a real estate business here in Denver, and it's one of the best real estate businesses that I've seen. He's one guy, and he does urban infill spec builds. And he does a bunch of them. He's got a system. He's got a process. He couldn't tell you what a cap rate is. He couldn't tell you anything about real estate finance and commercial. All he knows is he knows how to control expenses, build a beautiful house, and he'll make 500 grand plus per deal. And he does it over and over again. And yeah, it's transactional and it's not tax efficient, But he doesn't have 90 employees, and he's in and out of these things in 18 months roughly. So he doesn't want to scale. He just wants to keep finding his, 4 or 5 deals a year and travel and work out and do whatever he wants to. So bigger, again, is not always better, right?
That I really connect with that. That last story you told about your friend doing the urban infill. I really connect with that, doing fewer deals but with higher margins. What do you think? I mean, I don't know if you spend any time on social media, but social media is and podcasts and YouTube is littered with people telling you to 10x and just use other people's money and scale, scale, scale. What do you think are some mistakes that operators make when they're trying to scale? Either, and maybe mistakes that you yourself have made or that you see other operators making?
Well, wealth creation in real estate is a long, slow game. It is just like any business. It does not happen quickly. You might have some luck on a few transactions where you create a ton of value quickly and you blow out of them and you have a big liquidity event. But it's a long slog, riddled with challenges, operational challenges, debt market challenges, you name it. It's tough. But I'll say one mistake that I see folks make and that we've made and we still make to a degree. I'm not sure if these are mistakes necessarily lately or not. But I think selling quickly is often something that we see is sort of short-sighted. And I'll talk out both sides of my mouth here, right? I'm going to tell you in one side of my mouth, hey, philosophically, we like to hold for a long time, enjoy the cash flow. And the other side, I'll say, oh, we sold 2 deals a month ago after owning them for 2.5 years, right? So there's a time and a place to sell. But I think rotating capital too quickly is a mistake that we often, not necessarily a mistake, but I had a very elderly, intelligent, wealthy, experienced investor ask me a simple question. And he asked me, he's like, when are you boys planning on selling? And, I told him, oh, sir, 5, 7 year underwritten, this IRR, this multiple. And he asked me, he's like, the problem with selling, right? And I'm like, no, what's the problem? And his response was, you don't own it anymore. And that was one of the more profound, simple pieces of real estate advice I've heard is, gosh, yeah, you're right. You sell it, you don't own it anymore. So I think selling too quickly and too often is a mistake that's made pretty consistently. And I think one more that we see often, especially in this environment, and again, we've made all these mistakes too, is first of all, your underwriting model, your financial model for any deal you're going to do, ours included, especially ours, is wrong, right? A deal is never going to go like the spreadsheet says it will. It's always going to be better or it's going to be worse. It's not going to be a 16.15% IRR, right? It just isn't going to happen. So one mistake we see pretty consistently is unreasonably aggressive underwriting assumptions. So really aggressive revenue growth, occupancy growth. Maybe you've layered in the dream of a cash out refinance on year 2, and you're making that that distribution assumption as it relates to your IRR or your internal rate of return, your model. You show a big cash event, the IRR is going to go up. Timing of a refinance is impossible to predict, right? Especially in this environment. Where are rates going to be? What's going to happen? So I think being too dreamy in your assumptions is a mistake that we see fairly often. And we're guilty of it too. We got too aggressive. We thought we could grow NOI faster. We're not getting there. So whether you're considering investing as a passive investor or you're buying your first rental, I think being extra conservative in this environment is really important. It's okay. It's okay to exceed what you thought you were going to do, but it's always a problem when you're underperforming.
Jacob, we're getting to the tail end of our conversation, and I have so enjoyed getting this insight from you. I just love being able to do this and talk to people like yourself with so much more wisdom and experience than me. I've got a handful of questions left. They're designed to be more quick hitting questions, but if you have a good story or good insight, feel free to take your time and share as much as you'd like. In regards to capital raising, what are 1 or 2 or 3 of your best suggestions for raising capital right now?
Well, as I'm sure we all know listening to this, this has been a challenging capital raising environment. It's definitely improved a bit in 2024, but 2023 was pretty dismal. But raising capital, first of all, I think everyone will agree with this, but if you're a sponsor out raising money and so someone wires you $100,000 that you met on a Zoom call, they sign your documents, accepting that capital contribution is really a sacred responsibility. They're trusting you to go out and execute, and number one, not lose their money, but number two, deliver on the return targets that you would anticipate in your vehicle. So raising money is a noble and terrifying pursuit. A lot of responsibility comes with that. But our approach to capital raising has generally been keeping it very educational and not so much pitching your deal, but just giving an overview on the asset class, and then being forthright with the risks. We typically start off, or very early in an introductory call, we'll talk about the downsides before the upsides. I think those are more important. And a lot of passive investors who are kind of getting into the game, they often don't ask the right questions. And one question I think you should be asking any sponsor that you might be considering working with, regardless of the asset class, is tell me how I lose my money. Tell me about the risks here. What are you doing to kind of mitigate those risks and understand them? And then finally, tell me about your worst deals. I don't care about your home runs. You shouldn't care about their home runs, because a lot of these home runs were realized during investment landscape environment with huge tailwinds, right? The last couple of years up until really 2022, you had the perfect storm of rising rents and compressing cap rates. So you could be an operator who's going over budget, behind schedule on your project, not a good executor on your business plan, but you were saved by rising rents and compressing cap rates. Well, those days are over. So track record matters. But when someone gives you a track record, look at all my IRRs and multiples up to 2022. Yeah, good job. But everybody else did the same thing for the most part. So I think understanding how someone has handled failed deals and what those deals look like and why they happen, and understanding the circumstances that would cause a loss of principal are really important as you're getting to know a new sponsor.
Jacob, if you could 10x a certain part of your business, what would that be and why?
Well, every real estate investment shop needs three things, I think. They need capital, they need deal flow, and they need operational excellence. And we won't get into the third one because we talked about that for a minute. But on the capital and the deal flow front, the day that those two things are in balance for us is probably going to be never, right? It's always too much deal flow, not enough capital, and then the pendulum kind of shifts the next month. But our 10x right now, at least the last couple of months, I would say, is deal flow. We are struggling. We're finding them, but few and further between. We're struggling to find deals that meet our risk-adjusted return requirements, and it's not a lack of effort. We have 5 people on our acquisitions team. They're digging up deals. They're modeling hundreds and hundreds of deals every year. But 10x would be deal flow. But I don't even know if that's possible today, as we sit here, to 10x the number of deals you're looking at, the number of deals you're closing. The supply is just so finite. It's a weird environment. Not a lot of sellers are selling. But that would be the one I choose, deal flow.
You mentioned a minute ago that one question that passive investors should be asking operators is about their worst deal and how they handled it. So, Jacob, tell me about your worst deal and what you did with it.
Well, not a storage deal, but we had this idea many years ago that we're going to build a house out of shipping containers. And we're going to build it faster and cheaper than you can stick build. We're going to do a bunch of these. We're going to do 10 a year, and buy land and have a vertical building in 3 months and sell it over and over again. Well, we did our first and only house out of shipping containers, and it took 3 years. It cost a lot more than it would have cost if we stick built it, and we lost like $350,000 on the deal.
Oh man!
So what did we learn? Don't build a house out of containers. That's all we learned. Not going to do that again. On the storage front, I would say one of our worst deals was, thankfully we didn't have investors in this, but my partners and I had the proverbial 1031 exchange pressure. And we bought a deal in Iowa that we didn't love, but it was the only thing we could identify in time. And we closed on it. We didn't like the supply ratios. It was pretty beat up, relatively small. And we ended up selling that one just to kind of get out of it last year for a small loss. It never performed. And, the lesson learned there is really, if you're in a 1031, not to get too technical here, but don't let the tax tail wag the deal dog, right? Don't go out and buy a bad deal just because you're trying to defer a gain indefinitely. Those have been a couple of our worst ones, though, and we have underperformers in our own portfolio right now. But that's one of the benefits we think of doing fund vehicles. If you have 15 properties in a given portfolio, in a given quarter, two of those might be behind forecast. Maybe there was a new facility that got built, or unexpected repairs and maintenance, or softening consumer demand, but they're balanced out by the other deals in the portfolio that are hopefully on or ahead of forecast. So we've had some bad ones, and I'm sure we're going to have some more bad ones. But it's all just mitigating that risk and operating it more efficiently as much as you can to kind of hang in there.
Jacob, are there any habits or daily practices that contribute either to your business success or personal success?
Well, I'm still seeking success. I'll let you know when I get there, whatever that looks like. But not specifically, a system necessarily, but just effective calendar management. Notwithstanding, I say that, and we had to. You graciously pushed this recording back a few hours because I forgot about a school picnic today. But we're really diligent about blocking our calendars to think and to do tasks that require thought and time. And my calendar is 95% of the time it works every time, right? Except for days like today. But that's one really important tool, and we all have shared calendars, so we can see what other people in our business are doing, which is more efficient for meeting scheduling. You know that if someone's doing a one-on-one with an employee, you're not going to call or bother them. You just look at their calendar really quick. So calendar management's been a huge component to more effective time management and blocking that time for those deep thought, critical thought tasks.
Jacob, has there been a book, a podcast, a resource, mentor that has been instrumental in your development?
Well, right or wrong, I've read all the real estate books. I have a tough time getting through business nonfiction for whatever reason. I read the Cliff Notes, or I get 2/3 of the way through. So almost everything I read is historic nonfiction. And a recent book that I've actually read for the second time is called Into the Silence by Wade Davis, and it's thematically pretty similar to everything else that I'll read in historic nonfiction. It's an account of major adversity and how you're navigating that, and how you're navigating the pain. The specific book was about it's kind of about two themes. One is the experience in World War One of British soldiers. All wars are terrible. World War One was one of the worst. It was just hell on earth. And these guys were mountain climbers, and they led the early British expeditions to attempt to climb Everest. And on the last one, a couple of them were killed. But when you think about your tough day at work, I had a deal blow up, or whatever, this deal's not performing like I want it to. It's all relative. Like your feet are frozen, you have to amputate your toes because of frostbite. You're up there at 25,000 feet with hurricane force winds. You can't even light your stove to make your tea. So your challenges at the office on a daily basis here are all relative. And books like that kind of remind me of those challenges and how to keep it all in perspective.
Perspective is so important, and whenever I get a little bit down on my career or vocation, however that's going, I think about my one of my grandfathers who was a bricklayer for like 60 years, and I
Yep.
think, wow, okay, yeah, things could certainly be worse.
We are, say what you want about, political environments or the state of the world right now, but we are lucky enough to be alive in the richest country at the richest time in human history. And imagine if you would have been born in Ireland in 1700, right? You'd be plowing the field, living in your hovel, just trying to grow enough to survive, and hopefully half your kids make it past the age of 2. It's a completely different world now, and we're so lucky.
Jacob, I know there's a non-for-profit that you're a part of. I want to give you the opportunity to talk about that if you'd like.
Yeah, I'm on the board of a local neurorehabilitation hospital called Craig Hospital, and they focus on rehabilitating patients that have experienced spinal cord injuries and traumatic brain injuries. So it's unlike how most of us would connote a hospital. You go in there, there's a bunch of sick people laying in beds. You walk into Craig and people are on treadmills. They're learning how to use their power chairs. They're going through rehab to learn how to use their legs again if they can. It's a remarkable place, and I joined the board almost 2 years ago, and the patient stories and the outcomes have just been absolutely remarkable. It's also an independent hospital. It's not part of a larger system, and that independence allows them to really focus more on patient care than their bottom line. It's been a really rewarding experience, but I've thrown a lot of my time and energy into Craig, and our company is doing the same thing. We've got a number of Craig volunteer events we're doing this year. We've done gift matching fundraisers, but yeah, Craig Hospital, check it out. It's a worthy cause for sure.
And finally, if listeners want to connect with you, learn more about you or VanWest, where would you like to send people?
Always love to talk shop about real estate or tell you more about Craig. Folks can email me, Jacob at VanWestPartners.com, or go to our website, VanWestPartners.com, or hit me on LinkedIn.
Jacob, I sincerely appreciate your time. Really enjoyed this conversation and getting a little bit of your expertise today. Thank you so much for joining me.
Jonathan, gracious of you to have us on. I enjoyed it too. Thank you.
Listeners, if you enjoyed this conversation, feel free to reach out to either one of us. We love talking about commercial real estate, and we would love to connect with you. Thank you so much for listening. Until next time, take care.